One of the most important changes in the world usually begins quietly. It does not begin with a bell ringing on Wall Street. It does not begin with a government announcing that an old system is over. It begins with small moves that look separate until you understand the machine underneath them. An oil producer changes its allegiance. A central bank buys more gold. A country begins settling trade in another currency. A government that once recycled its oil dollars back into United States debt begins to do less of it. And most people do not see the connection because they are watching the headline, not the system that is the mistake I want to help you avoid. Because one of America's important oil allies has moved away from the organization that has helped manage oil production since the 1970s. And the bigger message is not simply about oil. The bigger message is about money. It is about the dollar. It is about how the global monetary system has worked for roughly half a century. And it is about why gold is reacting before most investors understand what is happening. When I look at this kind of situation, I do not look at it as a political story. I look at it as a cause and effect machine. Every system has inputs, incentives, pressures, and breaking points. For about 50 years, the United States dollar had a very powerful structural advantage. The world needed oil. Oil was priced in dollars, so the world needed dollars that created constant demand for dollars. Those dollars flowed back into the United States financial system. The United States could borrow more cheaply, spend more easily, run larger deficits, and maintain a standard of living that would have been much harder to sustain without that reserve currency advantage. That is what economists call an exorbitant privilege. But in my own way of thinking, I would describe it more simply. It was a machine that made the dollar the required currency for one of the most important commodities on earth. If you controlled the currency required to buy energy, you controlled far more than a payment system. You controlled a large part of the financial plumbing of the world. That system is not disappearing overnight. People who say the dollar is going to collapse immediately are usually being too emotional, but people who say nothing is changing are usually being too complacent. Both views are dangerous. The real story is not collapse. The real story is erosion. A monopoly does not need to disappear to lose power. It only needs to become less necessary. That is what I believe many investors are missing now. The dollar does not have to go to zero for the old order to change. Oil does not have to be priced entirely outside the dollar for the petrodollar system to weaken. Central banks do not have to sell every treasury bond for the reserve system to shift. The system only has to move from one dominant channel to several competing channels. That is enough to change returns, risks, and portfolio construction. So let me walk through this in a clear way. The first thing we have to understand is the petrodollar system itself, because a lot of people talk about it in vague or conspiratorial terms, and that is not useful. If you do not understand the mechanics, you will either overreact or miss the opportunity. Go back to the early 1970s. The world had gone through an oil shock. Arab oil producers had cut supply to the United States. Gas prices rose sharply. People waited in lines. The energy system became a national security problem. The United States needed a new arrangement. Henry Kissinger went to Saudi Arabia and helped create an understanding with the Saudi royal family. This was not the kind of agreement that many people online describe. It was not a simple 50-year contract with a clear expiration date. It was not a piece of paper that suddenly ended one day and caused the entire system to vanish. It was more informal and more important than that. It was a strategic arrangement. The United States and Saudi Arabia would cooperate economically, financially, and militarily. The structure had three major parts. Oil would be priced in dollars. That meant any country that wanted to buy oil needed access to dollars. It created an ongoing structural demand for the American currency. The second part was that the dollars earned by oil exporters would largely come back into the American financial system. Oil-producing countries accumulated dollars. They bought United States Treasury securities. They helped finance American deficits. This kept demand for American debt high and helped keep borrowing costs lower than they otherwise would have been. The third part was protection. The United States gave military support, weapons, and political backing to Gulf monarchies. The oil producers got security. The United States got dollar demand. The dollars came back into American debt. It was a circular flow. Oil went out, dollars came in, debt was financed, military protection reinforced the arrangement. That was the machine. For decades, it worked extremely well for the United States. It made the dollar more than a national currency. It made it the central settlement currency for global energy. And because energy is not optional, the dollar became embedded in the operating system of world trade. If Japan needed oil, it needed dollars. If India needed oil, it needed dollars. If Europe needed oil, it needed dollars. If any major importer needed energy, it had to pass through dollar plumbing. That created a constant bid for the dollar. And that constant bid helped America do something that most countries cannot do. It helped America live beyond its own cash flow for a very long time. That is not a moral judgment. It is a mechanical judgment. Countries that issue reserve currencies can borrow more, import more, and print more without facing the same immediate consequences that smaller countries face. But no privilege lasts forever without being defended by fundamentals. History shows that reserve currency systems change when the underlying economic, military, and political conditions change. The British pound did not lose reserve status in one morning. It lost it gradually, as Britain's relative power declined and America's relative power rose. The same principle applies today. The United States is still powerful. The dollar is still deeply embedded. American markets are still the biggest and most liquid in the world, but the unquestioned nature of dollar dominance is weakening. That is different from saying the dollar is finished. It is saying the system is becoming multipolar. And that matters. The second thing to understand is where the fractures are appearing. The first crack is the change in how oil producers think about their own freedom. Some oil producers do not want to remain locked inside production limits that hold them back when they have invested heavily in expanding capacity. If a country has spent large sums to expand its oil production and an organization tells it to keep output below what it believes is in its own national interest, eventually the incentives diverge. That is how alliances weaken. Not always because people become enemies, sometimes because their incentives stop matching. The UAE has been one of the most important oil and gas producers in the world. If it walks away from old production discipline, the message is bigger than a quota disagreement. It is a sign that the old cartel structure is under pressure. And when a major producer also aligns itself more closely with the BRICS world, the issue becomes bigger than oil supply. It becomes part of a broader shift in global trade. The BRICS countries are not simply a headline. They represent a set of countries that increasingly want alternatives to the dollar-dominated system. Some want alternatives because they dislike American power. Some want alternatives because they fear sanctions. Some want alternatives because their largest customers are no longer in the West. Some want alternatives because they see the long-term trend and do not want to be trapped in one currency system. The motives differ, the direction overlaps. The UAE has joined BRICS. Its largest customer is China. China has every incentive to reduce the need to settle energy imports in dollars. If you are China, you look at the world and you ask a simple question. Why should the world's largest buyer of many commodities remain dependent on the currency of its largest strategic rival? That is not an emotional question. It is a strategic question, and when a country asks that question long enough, it begins building alternatives. It develops settlement systems, it signs bilateral trade agreements, it encourages the use of its own currency, it pushes for long-term contracts that do not require the dollar as the only bridge. That does not mean the yuan immediately replaces the dollar. China has its own constraints. Capital controls matter, trust matters, rule of law matters, liquidity matters, reserve currencies are not created by slogans. But again, the point is not that the dollar must be replaced completely. The point is that the dollar can be used less. Less is enough. The second crack is that more countries are experimenting with non-dollar settlement. India made a rupee payment for UAE oil. Saudi Arabia has discussed longer-term oil arrangements with China, Russia. After being cut off from much of the Western financial system, has already been forced to operate outside the normal dollar channel. Each of these pieces may look small by itself, but systems do not usually break because of one dramatic event. They weaken because repeated exceptions become normal. A country settles some energy trade in its own currency, another country accepts yuan, another country holds more gold, another country reduces treasury exposure. At first, people dismiss it because the dollar is still dominant. Then the trend continues. Then the new channels become more liquid. Then the cost of using them falls. Then what looked marginal becomes institutional. That is how transitions work. The third crack is the recycling of oil dollars into United States debt. This is the part that matters most for ordinary investors, because it connects geopolitics to interest rates, deficits, inflation, and asset prices. The old petrodollar system did not only create demand for dollars, it created demand for United States Treasury bonds. Oil exporters received dollars. They needed to invest those dollars. Treasuries were large, liquid, safe, and convenient. So the money came back into the United States. That helped finance American borrowing. It helped suppress interest rates. It helped support the entire American financial system if that recycling slows. The United States still finds buyers for its debt, but the balance changes. Someone else must buy if demand weakens. Yields may need to rise to attract buyers if yields rise too much. The debt burden becomes harder to manage. If the debt burden becomes harder to manage, the pressure to print, repress, inflate, or intervene increases. This is how monetary systems connect. People often think of debt, oil, gold, and currencies as separate subjects. They are not separate. They are different parts of the same machine. China's holdings of United States debt have fallen sharply from where they once were. Some American allies, like Japan and the United Kingdom, have bought more. So it would be wrong to say everyone is dumping dollars in the same way at the same speed. That is too simplistic. But it is also wrong to ignore the pattern. The important question is not whether every country is selling treasuries. The important question is what the countries that are reducing dollar dependence are buying instead. And one answer keeps appearing: gold. That is the signal. After Russia's foreign reserves were frozen by Western governments, every central bank that was not fully aligned with the United States had to reassess its reserve risk. This was one of the most important events in modern monetary history. Not because Russia was right or wrong. That is not the investment question. The investment question is what other countries learned from it. They learned that reserves held in another country's system are not purely financial assets. They are political assets. They can be frozen, they can be controlled, they can be denied. If a country holds its reserves in dollars or euros inside Western financial plumbing, those reserves are only fully safe as long as the political relationship remains safe. That realization changed reserve management. It made gold more attractive. Gold has no counterparty. Gold cannot be frozen by a foreign banking system if it is held directly. Gold does not depend on a central bank's promise. Gold does not need to be someone else's liability. That is why central banks began buying gold at a pace that has been extraordinary by modern standards. Roughly 1,000 tons per year has become the kind of number that investors should not dismiss. When the most powerful institutions in the world, the institutions that create money, are buying an asset that cannot be printed. I pay attention. I do not assume they know everything. Central banks make mistakes. Governments make mistakes. Large institutions make mistakes, but when their behavior lines up with structural incentives, it becomes meaningful. They are not buying gold because they are watching internet fear videos. They are buying gold because the reserve currency system is changing, debt burdens are rising, and geopolitical trust is declining. That is the environment. Now let us connect that to portfolio thinking. The purpose of understanding macro is not to sound intelligent at dinner. The purpose is to make better decisions under uncertainty. A good investor does not need perfect predictions. A good investor needs a map of probable cause and effect relationships. If the world is becoming more fragmented, if countries are reducing dependence on dollar settlement, if fiscal deficits are growing, if money printing risk remains high, and if central banks are adding gold, then the probability distribution changes. Gold becomes more than a fear trade, it becomes a structural reserve asset again. That does not mean gold only goes up. Nothing only goes up. Gold can correct. Gold can become overbought. Gold can disappoint for periods of time. But the underlying thesis changes when central banks, oil producers, and major emerging markets are all operating with a similar incentive. They want to reduce dependence on a system controlled by someone else. That is the first major reason gold has become structurally important. Again, I would call it de-dollarization. Not dollar collapse, de-dollarization. That distinction matters. De-dollarization means the dollar's share of settlement, reserves, and strategic trust declines over time. It means more countries hold a larger portion of reserves in non-dollar assets. It means more trade occurs outside the old dollar channels. It means energy sellers become more willing to accept other currencies. It means the old monopoly becomes a dominant player in a more competitive system. Gold benefits from that because gold is neutral. It is not the dollar. It is not the yuan, it is not the euro, it is not the rupee. It is nobody's political promise. In a world where trust is fragmenting, neutrality becomes valuable. The second major reason is debasement. The United States has been running very large deficits for a very long time. Every dollar of new debt has to be financed in one way or another. It can be financed by genuine savings. It can be financed by foreign buyers. It can be financed by domestic institutions, or it can be financed indirectly through central bank balance sheet expansion and monetary manipulation. The form may change, but the pressure remains. When debt grows faster than productive capacity, the real value of money comes under pressure. Governments rarely say they are debasing the currency. They use more polite terms: stimulus, liquidity, support, emergency measures, quantitative easing, financial stability. But the result is often similar: more currency claims against a limited supply of real goods and scarce assets. Gold cannot be printed in the same way. Mining can increase supply slowly, but not politically and not instantly. That is why gold responds to debasement risk. It is not because gold produces cash flow. It does not. It is because gold preserves a certain kind of monetary scarcity when paper claims are being expanded. The third reason is diversification. In a stable, unified world, concentrated exposure to the dominant system can appear rational. If the United States is the unquestioned center, if the dollar is unquestioned, if global trade flows smoothly through one set of rules, then holding everything in dollar-based financial assets can feel safe. But in a fragmented world, concentration becomes a risk. Europe is rearming. The Middle East is unstable. Oil trade is shifting. China is building alternatives. Russia has already been separated from much of the Western system. Emerging markets are studying what happened and adjusting. This is not one event. It is a regime change. And when a regime changes, the risk of being overconcentrated in the old system rises. Gold is a diversifier because it behaves differently from stocks, bonds, and cash. It sits outside the usual counterparty chain. It has been a store of value for thousands of years. That does not make it magical. It makes it useful. A good portfolio is not built on magic. It is built on understanding what each asset is designed to do. Stocks are ownership claims on productive businesses. Bonds are promises to pay. Cash is liquidity. Real estate is a leveraged claim on land, shelter, and financing conditions. Gold is a monetary reserve asset without a counterparty. Each has a role in a world of de-dollarization, debasement, and diversification. Gold's role becomes more important. Now, how should a regular investor think about positioning? The first principle is not to panic. Panic is rarely a strategy. The dollar is not going away tomorrow. The United States still has the largest and deepest capital markets in the world. It still has enormous military power. It still has many of the most important companies in the world. It still has technological leadership in major sectors. It still has institutional depth that many competitors lack. So the answer is not to abandon the dollar or abandon American markets. That would be too extreme. The answer is to stop assuming the old monopoly remains unchanged forever. If the world is shifting, the portfolio has to become more balanced. That can mean physical gold for some people if they understand storage, insurance, and liquidity. It can mean gold ETFs for people who want easier exposure without handling the metal directly. It can mean gold miners for more aggressive investors who understand that miners are not the same thing as gold. This is important. Gold miners are a leveraged play on gold. If gold rises, miners can rise more because their margins expand. But if costs rise, management makes mistakes, or gold pulls back, miners can fall harder. They carry operating risk, political risk, and company-specific risk. So they are not a simple substitute for gold. They are an equity expression of a gold thesis that can be powerful. It can also be dangerous if sized incorrectly. Good investing is not just about being right. It is about being appropriately sized for being wrong. I have seen many people understand a macro idea correctly and still lose money because they expressed the idea badly. They used too much leverage. They bought too late. They concentrated too heavily. They confused a long-term structural thesis with a short-term trade. They were right in principle and wrong in execution. That is not good investing. So if gold is part of the thesis, I think about layers. There is the core layer, which is the strategic holding. This is not something to flip every week. It exists because the monetary system is changing and because gold provides non-counterparty diversification. Then there is the tactical layer, which may include miners or other vehicles when the setup is favorable. That layer requires discipline. It requires risk management. It requires knowing when the thesis is working and when the trade is simply emotional. The biggest mistake people make with macro investing is they turn every idea into a story they fall in love with. They say the dollar is dying, so they buy anything connected to gold at any price. They say oil is leaving the dollar, so they assume every commodity stock will go up. They say central banks are buying gold, so they ignore valuation, timing, liquidity, and risk. That is not how serious investors behave. Serious investors separate the long-term structural force from the short-term entry point. The structural force may be real. The entry point may still be poor. Both things can be true. That is why I prefer a principles-based approach. First, understand the machine. Second, identify the pressures that are changing the machine. Third, watch where the money is actually moving. Fourth, express the view with instruments that match your risk tolerance. Fifth, do not confuse conviction with certainty. Certainty is usually a sign that you have stopped thinking. The current system is telling us several things at the same time. Oil producers are becoming more independent. China wants to settle more trade in its own currency. BRICS countries want alternatives. Central banks are buying gold. The United States continues to run large deficits. The dollar is still dominant, but less unquestioned. Gold has already moved strongly, but the structural reasons behind the move have not disappeared. Those are the facts as I see them. The conclusion is not that everyone should make one dramatic bet. The conclusion is that investors should recognize the world is moving from a unipolar monetary order toward a more fragmented one. That means the assets that worked best in the old order may not be enough by themselves. It also means the assets that were ignored during the period of dollar confidence may become more important. Gold is one of those assets. Commodity-related assets may be another. Businesses tied to real resources, energy infrastructure, and monetary scarcity may behave differently from businesses that only benefited from cheap money and easy globalization. Again, this is not about fear, it is about adaptation. One of my core beliefs is that pain plus reflection equals progress. The world is going through pain because old systems are being stress tested. The reflection is understanding why those systems are under stress. The progress is positioning yourself so you are not destroyed by the change and may even benefit from it. Most investors skip the reflection. They feel the pain and then react. They buy after the move, they sell after the fear, they follow narratives. After the market has already priced them, that is why they are always late. The better approach is to study the system before the breaking point becomes obvious. The petrodollar system gave America an enormous advantage. That advantage is not gone, but it is being challenged. The challenge is not coming from one country or one event. It is coming from a combination of incentives. Oil sellers want flexibility. China wants less dollar dependence. BRICS countries want alternative settlement routes. Central banks want reserves that cannot be frozen. Governments with large debts want currencies they can manage. Investors want protection from debasement. All of those incentives point toward the same broad direction: less dependence on one currency. More demand for neutral reserves, more value placed on scarce real assets. That is the real story. Not that the dollar ends tomorrow, not that gold becomes the only money, not that one oil announcement changes the world by itself. The real story is that a 50-year machine is losing some of the forces that made it so powerful. Once you understand that, you stop being surprised by gold. You stop being surprised by central bank buying. You stop being surprised when countries experiment with non-dollar settlement. You stop treating each event as isolated. You see the pattern, and once you see the pattern, you can think more clearly. The market usually rewards people who understand structural change early and punishes people who wait until the change becomes obvious. But early does not mean reckless. It means thoughtful. It means patient. It means building a portfolio that can survive multiple outcomes. The dollar can remain strong longer than many critics expect. Gold can correct even when the long-term thesis is intact. Oil producers can talk about alternative currencies and still settle much of their trade in dollars. The transition can take years. It can move in waves. It can reverse temporarily. That is normal. Big cycles do not move in straight lines. But when the incentives are powerful, the direction matters. That is what I want you to take away. The petrodollar was not just about oil. It was about a monetary loop that created demand for dollars, demand for treasuries, and strategic advantage for the United States. When that loop weakens, even gradually, the consequences ripple through currencies. Bonds, inflation, and asset allocation. Gold is responding because it sits outside that loop. Central banks are responding because they understand reserve risk. Oil producers are responding because they want flexibility. Investors should respond by thinking, not by panicking. That means asking better questions. How much of my wealth depends on the dollar retaining the same dominance it had for the last 50 years? How much of my portfolio depends on the old assumption that foreign buyers will always eagerly finance American deficits? How much of my risk is hidden because the system has worked so smoothly for so long? How much exposure do I have to assets that cannot be printed, frozen, or diluted in the same way? How much am I relying on yesterday's world continuing unchanged? Those are the questions that matter. And the answers will be different for every person. A retiree, a young investor, a business owner, and a professional money manager will not all make the same choices, but they all need to understand the same machine. Because if you do not understand the machine, you are not investing, you are reacting. And reacting is expensive. The world is not ending, the world is changing. There is a very big difference. When the world is ending, all you can do is hide. When the world is changing, you can study the change, adapt to it, and position yourself intelligently. That is the opportunity, not the opportunity to make a wild bet. The opportunity to see the shift before it becomes common knowledge. The petrodollar system made America rich because it forced the world to need dollars. If the world needs dollars a little less, then the value of alternative stores of value rises. If the United States continues to issue debt faster than the world wants to absorb it, then debasement pressure rises. If geopolitical fragmentation makes foreign reserves more vulnerable, then non-counterparty assets rise in importance. That is the chain. That is why gold matters. That is why central bank buying matters. That is why oil settlement matters. And that is why investors who dismiss this as noise may be missing one of the more important macro shifts of this period. I do not know the exact path, nobody does. But I do know that when a major monetary system begins to change, the people who study it calmly usually do better than the people who mock it or panic over it. So be calm, be rational, be diversified. Understand the system. Watch the flows, respect gold's role, but do not worship it. Respect the dollar's strength, but do not assume it is invincible. Respect history because history does not repeat perfectly, but it often moves through familiar patterns of power, debt, currency, and trust. And above all, remember that money is not just paper or numbers on a screen. Money is a trust system. When trust concentrates, one currency can dominate. When trust fragments, the system changes. That fragmentation is already happening. The question is whether you will recognize it while there is still time to adapt, or whether you will wait until the headlines make it obvious and the best prices have already moved. That choice belongs to you.